It is updated BRSR with core factors, and it is applicable for 1,000 companies. So when there is a strict mandate, when there is regulation, so we are supposed to report on sustainability factors as well. And in the recent in the recent months, I can say European Union has banned the imports if there is no proper carbon footprint tracking. So every organization which is exporting to EU, they have to get CBAM certificate. If they're not having that, or if the rating is much lower than what is acceptable in the acceptable limits, then every organization is supposed to pay around 28% of carbon tax. Maybe it is postponed till 2025, but we are getting prepared. That is what our finance minister told. So to avoid all these restrictions, to meet the regulatory requirements or the mandatory requirements, we have to report on sustainability. When it comes to positioning, obviously when you're sustainable, you have better reputation. So if I take one example, Tatas, as we all know Tatas, we feel that they are, for them, CSR or this activity of community development or social development, it is a culture for them. Way back before CSR was introduced, the terms, these are just terms for them. CSR was introduced or ESG is introduced or whatever, they used to follow that. They always believed in value creation, community development. So if we start our sustainable practices today, we will be having a leadership advantage, though we don't fall under the listed companies or we are not a multinational company or a large company, but we obviously will have a competitive advantage compared to our peers. Then comes the fundraising. Fundraising, sustainable investment has become of much importance nowadays, because I can give you one example. When I was attending this GRI training, I was feeling that, my colleagues, they will be from the industries where there is lot of emission or carbon footprint, that kind, or people like us who are interested in the reporting structure. But for my shock, I saw people from NGOs attending the trainings. I saw people from banking. So I was very much keen on knowing why bankers are attending this seminars or workshops. So what they told was, even their bank have to report on the sustainability practices. So one of the responsible banking practice is, whomever they are lending, that is nothing but sustainable investing, those companies have to be sustainable, or they have to practice sustainable frameworks. So that is how they had come for the workshop. Then when it comes to cost saving, obviously when we adopt sustainable practices, it will indirectly result in cost saving. Here also I can give one example. I was making one BRSR report for a foundry. Foundry is like, they make castings for the bigger automobile industries. So there they use sand for the making of castings. So whatever sand is used, that was disposed completely. But when they switched to sustainable practices, they were looking for the way out, how to make our practices sustainable in the organization. That sand could be reused. Only 5 to 10% of the sand contains the minerals which are hazardous. So that can be disposed properly. 90%, 85 to 90% of sand can be reused. That is called as sand reclamation in foundry. If we see in India, there are around 90% foundries which are in MSMEs, and in that only 70% of them, no, 70% of them are not reclaiming the sand. Only 20 to 25% of foundries are reclaiming the sand. So they are not aware that that can be reused. So this is what happens when we try to look for the sustainable options. So next comes the productivity. So my topic in PhD was impact of stakeholders on sustainability reporting. So when we interviewed the stakeholders, it was long back in 2014-15. Nobody was aware, but there were reports. Because of the multinational presence, many companies, big companies, they were producing GRI reports, sustainability reports, but stakeholders, when we interviewed, they were not part of the sustainability reporting. But in GRI, they strictly tell that stakeholder engagement process is very much important. So now if we see, if I repeat my same survey, I think now stakeholders are well off in that matter. So we have to involve our employees and various stakeholders in framing the reporting practices. So that gives them the kind of accountability and ownership, and it will increase the performance and reduce the attrition rates. So why many organizations globally are reluctant to follow the sustainable practices or report on the sustainable frameworks? It is because of this thing. If we can see, there are over 600 different ESG frameworks, sustainability reporting standards, industry initiatives. Industry initiatives are, if you are in a real estate industry, GRESB is applicable. If you are in cement industry, there is one more framework applicable. Because of this complexity, many organizations, they don't even turn towards sustainability reporting. So the most widely acceptable frameworks in India and globally, it is GRI framework. GRI started way back, more than 2 decades back in 1997, and from 2000 they started producing the guidelines. Standards were not released. G1 was the guideline released in 2000. G1, G2, G3 and G4 were released. Later on in 2016, a proper set of standards were released by GRI, and then in 2021 the updated standards were released. There are 3 sections in GRI. First is the universal standard, irrespective of which sector you belong to, whether it is a larger organization, mid-size or smaller organizations, you are supposed to report on the universal standards that contains the basic details of your organization. So when it comes to sector specific standards, only few sector specific standards are released, like steel, power, energy, and topic specific standards which relates to water efficacy or waste management or climate. Those standards are released, so we can follow those standards and we can report in our we can follow that framework. So GRI is called as the mother standard because it started way back its work, and it is widely accepted and it is getting improved every year. So when it comes to TCFD, TCFD is also widely accepted because of its inclination towards the climate related disclosures. Paris Agreement in 2015 was a great move, but what happened was there was no monitoring system. So whatever net zero targets or the climate reduction up to 2 degrees or 1.5 degrees, whatever was agreed was not monitored properly. So that was the reason TCFD was introduced with its 4 pillars, that is the governance, strategy, risk management, and metrics and targets, where the management is given the responsibility to fix the targets which can be achievable. And the risk has to be identified and mitigated and managed. And the strategy has to be formed where that will lead us to achieve our targets. So this is the IFRS sustainable reporting landscape. The reason for me to tell about GRI and TCFD is those are the main standards which complement the ISSB in making their IFRS S1 and S2. IFRS, it took all the advantages or the points from all the existing standards, and they have drafted the S1 and S2. If we see SASB and integrated reporting, which used to report on capitals, various capitals, that is the human capital, environment capital, social capital. So those were integrated into VRF, that was Value Reporting Foundation. Then there was CDP, Carbon Disclosure Project, exclusively, which monitored the carbon footprint. by CDSB. These two were merged to IFRS. Then the IFRS set up a different board, ISSB. IASB is for accounting standards and ISSB is for sustainable standards. Then TCFD was merged into ISSB. If we see TCFD, they have told that we have disbanded, even their website is updated only till November. So after that, ISSB has taken over TCFD, and GRI, it is complementing the ISSB standards, that is S-1 and S-2, because GRI, as I said, it's a mother standard. It is having lots of details which can be taken from. So nothing is overruling that, but it is complementing the ISSB. So why ISSB? Why was it really necessary when we have so many standards? Was it really necessary to have a separate board and prepare a set of standard? It was very much necessary. If you remember the previous slide where we have more than 600 standards, frameworks, initiatives. So many people, many organizations, they think sustainability reporting is complex. That has to be simplified. So the main goal of ISSB standards, it was designed to create common language for addressing business opportunities and climate risks. As I said, it was built on the same 4 pillars of TCFD, that is governance, strategy, and risk management. And it facilitates the standards of ISSB, facilitates in robust, comparable, and verifiable reporting. So if one country has a different set of framework and reporting, if the other country is having a different framework, we are seeing in the reports, what we do is we make one ESG report and we map various frameworks to the same ESG report, that is CDP or TCFD or GRI. All these problems will be solved by introduction of these two standards. These are the initial standards. It will go on increasing. Because of ISSB, all these things will be standardized. And there will be a uniform reporting system which will facilitate in investment decisions. I need not see CDP report for some decision. I need not go to GRI report for some decision. So there will be a uniform reporting system. So integration of financial and sustainable information. Always an organization thinks that, only finance speak the success of the organization, but it is no more true in any sense. If my company is not sustainable, it cannot exist for a long term and it will be outside the race. So as I said, there are two boards, that is IASB and ISSB. So accounting standards, IFRS accounting standards and IFRS sustainability disclosure standards. One is the financial statements, the other is the sustainability disclosure statement together, where there will be cross-reference to the details if required. For example, there is CapEx incurred for sustainable practices. We have one point where we have to include that. So the same can be cross-checked with our financial statements as well. So it will help investors and capital market participants and various stakeholders in the decision-making process. So this is the last slide of discussion. So materiality assessment has become a buzz in the market when it comes to global frameworks. GRI, it was insisting on materiality assessment. So it was single materiality assessment, but now in ESRS, they're asking for double materiality. As of now, IFRS is based on single materiality. Slowly, it will be converted to double materiality. So I thought, let us have one discussion on this point. So materiality is the first step when we start making the ESG report. We, with the stakeholder interaction, identify the impact factors and we map those factors and rank them. So for example, in traditional materiality or single materiality, if we take example of unproductive employees. So in this, there is financial impact on the organization. Because of unproductive employees, it affects the company's revenue. This is what used to happen all these years. But when it is double materiality, one is unproductive employees affect the company's revenue, but why the employees are unproductive? Is there any problem in the system, in the organization? Can we correct it? This is the double materiality, and which it is a welcome step, what I feel. Companies governance affects the employee satisfaction, which in turn is resulting in unproductive employees. So if that is the case, organization should also take steps to avoid this. So by this I end my discussion. So any questions can be posted in Q&A section. So this last slide, it is telling, let us not leave the carbon footprint. Let us leave the green footprint for our future generation. And I thank you again for giving me this opportunity.
Thank you so much, ma'am. There are a few questions, but I believe if you would like to take it now, or probably we can, move on to the next speaker.
Yeah, your wish, ma'am. Whatever.
So we'll take it up at the end of the session.
Yeah, because I'm waiting for Atul sir's session badly.
All right, I think we all are. So I will call upon and I'll introduce our next speaker, CA Dr. Atul Kumar Gupta sir. He is the founder, promoter, and director of ESG Research Foundation. He is also on the board of IFAC and XBLR International, chairman of GST Committee of FII, and past president of ICAI. CA Gupta has authored many relevant books and has published numerous articles in leading newspaper, magazines, and professional newsletters, and delivered lectures over more than 600 in more than 600 seminars and conferences. So I welcome CA Atul Gupta sir to share his deliberation.
Thank you, Juiji. I believe I'm audible. I'm audible?
You're audible, sir. Yes, sir.
Thank you, Juiji, and my regards to our very dynamic and our co-speaker Rashmi ji, Rajesh Bhalla ji, Deepak Batra ji, and all my colleagues. As Rashmi ji set the tone, my dear friends, that why it is so important that we all discuss about the ESG, and you are aware that in spite of we are having the domain expertise in the different fields, still we believe that we all should discuss this important aspect, and whatever bit we can do, we should do, so that ultimately we are saving our mother planet with all the challenges which we are facing these days. So my dear friend, when we discuss a fundamental aspect, that whether this ESG is more of a value proposition or a values proposition. So I discussed on the many occasions that so earlier days what was happening, that the ESG was looked as more the values perspective, meaning thereby that it's moral value, that we should take care of the planet Earth, and primarily it is the government duty, the governments at the various jurisdiction, that they have to take care of the sustainability part or the ESG governance part, environment part. But later on, what happened when after this 2004 and the Sustainable Development Goals, gradually that becomes an investor call, that we will be investing in all those companies only which are having the better ESG compliance as compared to the companies which are not the ESG compliant, maybe because of the various reasons that, as she mentioned, the Rashmi just mentioned, that if you want to export to the European Union, then you have to be certified, or you have to be a net zero or maybe a ESG compliant organization, and you should have a better rating. So now the ESG compliant, to be a ESG compliant is not remain a luxury, but become a necessity. So you required a lot of things to implement, adopt as far as the ESG is concerned. I just wish to share with you that when she talked about the TCFD vis-a-vis the ISSB, that earlier the TCFD was a separate requirement, that you have to be compliant with the TCFD if you want to export in the European Union. But now with the introduction of the S-1 and S-2, the two standards vis-a-vis the IFRS 2 standards on the sustainability, as she depicted in this her presentation. Now, if you are S1 and S2 compliant, meaning thereby that you are the TCFD compliant as well. So meaning thereby, since the TCFD merged into the ISSB, So now they're meaning thereby that if your organization is compliant with the S1 and S2, automatically you will be eligible for the similar kind of benefits which are otherwise available if you are a TCFD compliant. Now, my dear friend, as we discussed that in the earlier days, there was no methodology was there to monitor like to depict the monetary value of the ESG aspect. Say, for example, for air pollution or something like that. So all these were the subjective issues. There was no quantitative model was not available, and even the details were not verifiable. There was no regulatory requirement was not there, and ultimately they are not comparable. The financial performance cannot be compared. So there were many issues were there. So with the advent of the ISSB and the other developments which she just mentioned, now we come to a situation when from the 1st of January 2024, the IFRS S1 and S2 become compulsory, mandatory, as far as those organizations which are following the IFRS. So now one thing is there that each one of us has to, so though in India we are following the Ind AS as compared to the IFRS because they are the converged kind of a situation. But still I will say that the companies who are looking for a global listing, they are having the global presence and their financial statements are getting reported at the different jurisdiction. It is good for them that they are adopting the IFRS S1 and S2. Not only as a matter of a luxury, but also as a matter of a necessity at the earliest occasion. Now, my dear friend, what is this IFRS S1 and S2? I will give a brief overview because today we are giving an introduction kind of things, and maybe some other occasion we will go with a more illustrations, case studies as far as this S1 and S2 is concerned. My dear friend, I believe that this presentation is visible to all of you. That when we talk about this S1, so S1 talks about this disclosure, the disclosure of the information related to sustainability related risk and opportunities. So my dear friend, when we talk about the organization, say for example, our organization is there, which is maybe let us take an example of a hotel. I will give you a simple, very simple layman example. In a hotel is there and they are having 20 branches. Now, out of the 20 branches, there are few branches which are in the water stressed area, or there are the few branches which are in the hills where the number of landslides are happening. So now there will be a risk in a short term, medium term, or in a long term that the hotel has to close down those branches, maybe due to regulatory requirements or maybe because of the ecological challenges. They have to close down out of the 20, the 5 of the branches or the 5 of the hotels of that particular chain of hotel. Now, what will happen that ultimately there will be the challenge that the revenue will hit. There will be an impact on the cash flow. And ultimately, the investor would like to see that what will be the net cash flow after the 5 branches will be closed down, or what is your strategy to handle that kind of a situation. Now, my dear friend, this is something that I will say in a nutshell that the one organization has to depict, has to declare, or has to give in their financial statement that this is sustainability related risk which I am working with, and this is my mitigation strategy so that the investor will be taking an informed decision. So, my dear friend, this, if you will see on the presentation, that to disclose the information by entity about its sustainability related risk and the opportunity so that it will be useful for the primary user. So when the primary user means the investor, the who is going to take decisions to invest in the company, or maybe the regulator, or maybe the credit suppliers. So they have to take a decision based on the financial reports that, okay, whether I have to go ahead with this company or not. Now, my dear friend, as you will see that the objective talks about in a detail to assess the ability of the entity to handle the sustainability related risk and the opportunity. So now take the same example. So whether the organization will be able to handle that sustainability related risk. So 5 branches are going to close down, maybe in the 3 years, 5 years down the line. So whether they will be able to open the new branches, their cash flow will continue to be there, or there will be a drop in the cash flow or in the revenues or the EBITDA of that organization because of the sustainability related risk, is something that somebody wishes to assess. So that whether they will be able to generate the cash flow. So the next one is to whether this generate cash flow over a short, medium, and long term, linked to the interaction between the entities and its stakeholders, society and the economy and the natural environment. So what will be the impact of the natural environment, the ecological challenges? For example, we are all hearing on a daily basis that the Maldives or some countries where they are on a very near to the sea level, the country level to the sea level is very, I will say, nearer. So they may be submerged into the sea maybe 20 years, 30 years, 50 years down the line. So how they are going to mitigate? So whether there will be a challenge as far as this environment is concerned, and how they are. So say, for example, the bank is there. So Rashmi talked about that why the bankers are joining. Now the bankers, when they are giving the money to the borrowers, so not only they have to check the credit worthiness, but also they have to do a environmental aspect as well. The environmental impact as well, that whether the organization should not, so but it should not be a case that the organization is living in an ecological sensitive area and tomorrow there may be a restriction by the government or because of the natural environment that the organization has to shut down. So then accounts will become NPA. So ultimately, it's not only the credit worthiness that okay, the tax compliances, it is that the banker will be interested to check so whether they will be able to sustain the cash flow which we are banking upon. So now the third aspect, as you can see, to access its access to finance. So the cost of capital. So what should be the cost of capital? So if the organization is more vulnerable, the cost of capital will increase. So otherwise, as compared to the organization which is more sustainable, so the cost of capital will go down. So this is exactly I was mentioning about that somebody has to disclose the information in such a way that somebody will assess that what will be the position, the cash flow position, is ability to sustain in the environmental challenges, so that the cost of capital will decide. And then the standard talks about that how the entity will prepare and reports its sustainability related financial disclosure. So my dear friend, what I'm giving a objective, the overall objective of this sustainability standard, that the reporting of the sustainability related risk and opportunity should be in such a way that the user of that financial statement should be able to assess the ability of the organization to handle the sustainability related risk, whether they will be able to generate the cash flow or not, what should be the what is the position to access the finance or the cost of capital, and then this overall methodology that how you are going to report all these information so that the reader of the information, the user of the financial statement can assess that where the organization stands today. Now, my dear friend, when we talk about this sustainability related risk, now what will happen that there are the situation when the risk can be assessed in a near future and they will be reasonably expected. So, for example, when you are, say, for example, the organization is there, which is very near to the sea. Now, there may be expectation that, okay, the sea level will increase or there may not be. But in case the organization, the hotel is running in a hilly area where there is a large scale landslidings are happening. And the government is very worried about that the government may be giving a ban on the running of the hotel in that particular area. So the reasonableness. So when you are creating I will say the risk, you are assessing a particular risk. So whether that will reasonably be expected to affect the entity's prospect or not is something that need to be. So in case there is a uncertainty of that, okay, this may be a risk or this may be not a risk, then again the standard says that, okay, you have to see that only the reasonably expected risk should be declared. It is not that you are giving on a guesswork. So guesswork will not work. There should be a reasonably expected kind of a situation should be there. And then you also give a time horizon. So when you are reporting that, okay, this may be a risk, so you have to give that, okay, in the 3 years down the line, there may be a situation that I have to shut down my hotels in a water stressed area or in a hilly area, or it will be 5 years, 7 years down the line. So that one has to give specify the time horizon that what is the expectation of the sustainability risk is there. And then the organization also explain that why they have taken this is a short term, medium term, or long term. So why they are saying that, okay, it will not impact in the short term, it will be impacting only in the long term. And what is the meaning of your long term? So that also 7 years, 10 years, like that, you have to give that, okay, this is the meaning. And then, my dear friends, it also depends on the various factors. For example, the entire industry in a particular area is going to be banned by the, say, for example, the NGT is there. Now, the organization of a particular type is working in a particular area, which is a more of a forest area, or the government is looking that, okay, this type of industry should not work in this particular area because of the ecological challenges are there. So when there will be an impact, it will be impacting the entire industry of that particular characteristics. So that also the organization has to reasonably expect, and then has to declare that, okay, this is something that, okay, I am working with, and now I am trying to mitigate this particular challenge. So when you are disclosing into your financial statement, that aspect you have to declare. Now, my dear friend, the sustainability standard S1 says that if you are following, as the Rashmi mentioned, that there are the other frameworks also available. So if the particular industry or a particular company is following any other framework, that also you can use. You can give a cross reference that, okay, I am also disclosing this information because of this particular framework. So there is no separate requirement. That is, no separate disclosure will be required, because the similar thing I am disclosing. Say, for example, you are giving a water related disclosure because of the CDSB framework. So now there will not be any separate disclosure required under the ISSB S1 or S2, as the case may be, because you are already giving this information into, because of the some other framework you are supposed to be complied with. So, my dear friend, as I mentioned you with this brief introduction, the scope of this S1 is talks about that the only the reasonably be expected. So you have to give a SRRO, the sustainability related risk and opportunities, which are reasonably be expected to the organization, and irrespective of this fact. So whether you are following the IFRS or any other gap, say for example, we are following the Ind AS. So that also you have to, irrespective of this fact, that whether you are going with the IFRS or not, you have to adopt this S1 and S2. Number 3, these standards is applicable on a primarily on the private sector, like the commercial organization. But in case this somebody wish to adopt this as a not-for-profit organization, then they can do some kind of a description amendment can be there. So that facility, that kind of a flexibility has been provided in the S1 and S2. Now, my dear friend, the S1 and S2 is the 5 pillars on which the S1 and S2 is working. Number 1 is a fair presentation. Then when you are giving a S1, you are adopting the S1, it should be a fair presentation, materiality, governance, structure you have to give. You have to give us the strategy as well as what kind of a risk management strategy you are adopting. That also be declared by the organization. Now, my dear friend, when we talk about the risk fair presentation, the standard says that when you are giving certain disclosure, say for example, again going back to the hotel. So when you are giving the details of the, say for example, you are giving a 5 hotels are falling under the sustainability risk, then whatever the disclosure you are giving, that should be a comparable. So you have to give a comparable kind of. So I am, say for example, you can't say that, okay, my 5 hotels are in a trouble. No, you have to give that this was the cash flow in the earlier year from these 5 branches. And now this is something that I am worried about. This 3 years, 5 years down the line, there may be an impact on these 5 branches. And because of that, this much of a cash flow will be impacted. And now this is my mitigation strategy that, okay, I'm opening the new hotels. I'm shifting my hotels to some other location so that the cash flow will continue to be there. So this is my mitigation strategy. So the information which you are giving should be a comparable and now verifiable. So again, as I mentioned you, that if you will be able to give a detail of the 5, the cash flow from the 5 branches, that will be automatically verifiable. But as a kind of a theoretical subjective information which is not verifiable will not be useful for the reader. So the information, whatever information you are giving should be verifiable. It should be timely, that you are giving the information well in advance. It is not a case that you will be giving the information when the order from the government will come to close down. So that will be practically a post facto. But you have to give a timely information, understandable, so somebody can understand. And in case the standard says that if you are giving certain, if you feel that the certain information is required beyond the standards asked for, then the additional information should be given by the entity so that it will be look like a fair presentation. So fair presentation, as I mentioned you, should be a, so the test of the fair presentation will be whether this information is a comparable, verifiable, timely, understandable. Then only the information will be, whatever information is given will be treated as. Now, my dear friend, materiality. So the second point, which is again very, very important in the entire IFRS, you are aware that the materiality aspect is very, very important. Similarly, in the case as well, they talks about the materiality one has to take care. Number one, they say that the materiality you have to decide. It is not a case of a 2% or 5% like this. In the IFRS normally happens that you have to take them. So that you have to take the materiality as far as that particular aspect is there. Now, my dear friend, they say that the materiality means that if the omitting, misstating, or obscuring that information could reasonably be expected to influence the decision. So if you are not giving the certain information, or you are misstating the information, or you are obscuring, I will explain you what is meaning thereby, that if you are doing this, and then my decision will change. So for example, you are not giving the details of those 5 branches, meaning thereby my decision will be that I will see that the hotel is performing good, very good, and I should invest in that. But suddenly what will come that, okay, after 3 years down the line, I will come to know that, okay, no, these 5 branches are getting closed down. So meaning thereby you have not given the right information. So the omitting or misstating any which will change my decision is something which is talks about that will be a material information. So now you are aware that the primary users what will be using that information. So the standard says that the decision of the primary users may relate to buying, selling, or holding the equity, providing or selling the loan and other form of credit, or right to vote, otherwise influence or entities management action that affect the entity's economic resources. So all these are the purpose of these information. So the standard says that the information should not be getting omitted, misstated, or obscuring, so that this will change the decision of buying or selling of the shares or something like that. Now, my dear friend, materiality judgment, as I mentioned you, is specific to the entity. So the entity may decide that what should be a threshold. It is not a case that like in IFRS, they have given something like that. It is purely on the same. Similarly, they talks about that if you are using certain metrics, say for example, you want to give a kind of you want to give a metrics for the purpose of the disclosure. So there may be a case that the company can create their own metrics, or there may be a situation that some industry has developed. A particular sector has developed some metrics, and that metrics can be used by the company entity here in the question, and you can use that particular metrics itself, so that you will be giving a kind of information which is equally comparable. So what will happen, say for example, X hotel is there, and the hotel industry is creating a information in a proper metrics that they have developed. So if the X is giving the information in the same metrics, it will become comparable for the sector, that okay, this hotel is performing well, or this hotel is not performing well. Similarly, my dear friends, is talk about that as I mentioned you, the uncertain outcome. So if the information have the uncertainty, you don't have a reasonable expectations, then we should not be providing that kind of information. That is something is there. And as I mentioned you, the additional information in case it is required, you should give. Now, my dear friend, when I talked about the obscured information, as I clarified you, that should be giving a clear distinguishedness. That should be there. It should not be a vague or scattered. So what is, it should not be there that some information you are giving on the page number 1 and some information you are giving in the page number 7. So you created the information in such a way, it's so scattered that nobody will be able to correlate. And then the very, very important word, which I just wish to mention you, is the inappropriately aggregated or disaggregated. Now, my dear friend, what the standard says that in case the X information or the Y information have the common characteristics, so they should be properly aggregated. It should not be a case that, okay, you are merging the two information which have the different characteristics, and you are merging just to that, okay, you are giving the information, but nobody will be able to conclude that what is the actual result of this particular aspect. So when you are aggregating the information, it should be appropriately aggregated or disaggregated. Disaggregated means that you are dividing the information into the different parts, but actually they should be clubbed. So the information which should be clubbed is disaggregated or scattered in such a way that the materiality lost is there. So that's a very, very important point which talks about that the obscured. So you are actually not omitting, say for example, you are not omitting or misstating, but you are obscuring the information, meaning thereby you are disaggregating the information in such a way or scattering the information in such a way that you will say, I have not omitted. So I have given the entire information, but actually that is scattered in such a way that nobody will be able to conclude that what you want to convey to your user of the financial statement. So this is aggregation and disaggregation. I have already explained you. Now, my dear friend, this standard also give a very good opportunity, I will say, to the entities that if they feel that the certain information is commercially sensitive. So if I will give a commercial sensitive information, say for example, the pricing or some business model, then that will be prejudice to my economic benefits. So then the standard says that, okay, no problem. You can omit that information from the disclosure. There is no problem. But the further the standard says, but that information should not be otherwise available in the public domain. So on the one side, you are saying that it is a commercially sensitive information. I will not give a disclosure on this. But otherwise, this information is available in the public domain. Then how you can say that is a commercially sensitive information? This information is otherwise available. Also, similarly, if the entity elect to use the certain exemptions. So if they are looking for certain exemption, they have to see that why this exemption you are looking for, what kind of information you are supposed to give, and why you are qualified for this kind of exemption. That also the organization has to disclose in their financial statement. Okay, this is something that, okay, I'm not giving because of the following reasons. So they have to give a following reason. And as I mentioned you, the exemption, on the one side you are saying it is a commercially sensitive, on the other side, what is happening that the information is generally available, that should not be a case. As I mentioned you, my dear friends, this disclosure is something that in case, say for example, you are giving a holding and the subsidiary accounts are getting consolidated in the holding entity, then the information should also be present in that way with the same relevant period. So in case you are consolidating the subsidiary into the holding, similarly, then you have to give the information for the entire group rather than for only for the subsidiary or the holding, as the case may be. Similarly, my dear friend, this is very similar to which I mentioned you, the disaggregation or aggregation, that in case there are the certain connected information. So then you have to give a cross references or the connection that, okay, this is something that, okay, I'm creating a strategy or I'm doing this kind of a trade-off, something like that. And that information you have to give into your financial statement in such a way that somebody will be able to correlate that what can be the risk and opportunities associated with the sustainability will be. So my dear friend, the connected information is practically a kind of a additional information, or I will say the presentation, the way of presenting the detail, so that somebody will be able to conclude that what is the risk and the opportunity the organization is working with. Similarly, the cross-reference, that in case you are giving a cross-reference of certain terms or the certain information, that also should be disclosed in a proper way so that the user can read the details in a well-structured manner. Now, my dear friend, coming to the third and the very important part is a governance. So, my dear friend, the standard also required that every organization who is adopting the S-1 and S-2, they have to give a governance structure. So it is not a governance structure of the organization as such. It is the governance structure which will supervise or control the activities related to the SRRO, meaning thereby sustainability related risk and opportunity, meaning thereby there should be a board or the committee who is charged with the governance, or the individual who is responsible to oversight the SRRO. They have to declare. Not only they have to declare that which committee is going to govern the SRRO, but they have to give the terms of reference, that the mandate, the roles, the policies applicable, whether they have the proper skills and competencies are available or not, how often they are meeting, what kind of information they are getting, and what kind of overseeing they are doing, and how the targets are set, and who is monitoring those targets are also there. So, my dear friend, I have given in my presentation that the entire, I will say the to-dos by the that kind of a board, committee, or individual who is responsible for the oversight of the SRRO, that also has to give a clarity with a clear mandate is there in the S1 that you have to give into your disclosure, that what is the governance structure overall. Then, my dear friend, the last but not the least, the two aspect is about the strategy, that what is your strategy to manage this sustainability related risk and opportunity. So one way you have to do that, the entity has to give that what is the current and anticipated effect is there, what will be on the entity's prospect, what is my business model, what is my value chain, and how we are factoring into our organization's planning, that how we will be able to create a resilience against these kind of challenges will be there. So the organization entity has to depict that what is the strategy to handle this sustainability related risk as far as these various geographical areas, facilities, type of assets which are under the challenge. And then they have to give a progress against the various plans as well. What is the trade-off between the benefits vis-a-vis the risk which are there into the ecosystem? And that the information as the standard required, that you have to give not only the qualitative, but also you have to give a quantitative information as well. And quantitative information, you may give a single amount or a range as well. So what will happen, that there may be a chance of a 10 to 15% impact on the cash flow may be there. And you may give the exactly the 12% challenge will be there. So they have given that, okay, you can give a range rather than you are looking for a single amount as well. So my dear friend, as I mentioned you, this matter like the various aspects related to the strategy, the comparative information, I have just explained you. And last but not the least, as far as the S1 is there, the risk management, that how the management is, the user will be able to understand that how the organization is able to process identify what is the, how they are able to quantify, how they are prioritizing the challenges, and then how they are monitoring the sustainability related risk and opportunity, so that the user of the financial statement will be able to assess that whether I should vote, I should continue to hold the equity, I should invest or not, whether I want to give a loan, whether I should give a loan or not. So it's basically the overall risk profiling. So the organization has to provide information vis-a-vis the overall risk profile, that what is the risk management process is there in the organization and where they stand today. My dear friend, the one very, very important aspect which I just created a bold into this presentation is a scenario analysis. So the entire standards talks about that you have to create the scenario analysis. Scenario analysis means that you have to give a kind of a situation, and then say, for example, you are saying that, say, for example, in my hotels are there in the hill area, and this is a scenario which I just given you in the initial level. So this is a scenario that you are creating that, okay, if this will happen, so this will be the challenges and how I am going to mitigate these challenges. So you have to create a kind of a illustration. So scenario means you have to create a hypothetical situation or a situation that, okay, if this will happen, then this will be the impact and this will be a challenge. This will be the how we are going to mitigate. So the nature, likelihood, magnitude of the effect, everything you have to create in a scenario analysis, and then you have to give to the reader of your financial statement that, okay, this is something that, okay, I am looking for, I am working for this, and this is something that I am declaring, so that the reader of the report can assess, oh, I should invest in this organization or I should not invest in this particular organization. So my dear friend, you have to create the metrics and targets, meaning thereby you have to create a matrix that, okay, this is something like in a table way that you are giving that, okay, this is something I am going to achieve. 5 years down the line, if the 5 hotels will close down, I will be creating the 5 new entity, 5 new hotels, so that I will be able to mitigate the risk. Something that, okay, I'm giving a matrix and I'm giving a target, and then I'm giving a goal achievement as well, that where we stand today. So that you have to depict in your financial statement, in your annual report in such a way that the reader can understand that, okay, where you stand today. So this is all which is there I have given in my all my presentation. And now coming to the, for few minutes only, maybe 2-3 minutes about the climate related disclosure, that is S2. So my dear friend, when I talked about the S1, S1 talks about a journal disclosure. That is the sustainability related risk. When I talk about the sustainability related risk, means every risk related to the sustainability. But when I talk about the IFRS S2, that talks about the one part of the sustainability, that is the climate related risk. So my dear friend, practically S1 encompasses the entire S2 as well. So it is the S2 which is applicable on certain organizations which are more vulnerable to the climate related risk, and S1 is more general. So it is S1 and S2 which I just wish to clarify, and rest of the things are more or less same. One very, very important aspect which every organization has to disclose as when you are following the S2 is this, that the physical risk and the transition risk. So physical risk, as I mentioned you, that maybe the impact of the landslides, impact of the floods, forest fire, that okay, what kind of an impact can be there. And the transition risk is that when the organization want to move, from more carbon related. So the organization want to move towards the less kind of a, say for example, you are emitting the lot of greenhouse gases. So you want to move from a higher carbon related activity to a lower carbon activity. Then what kind of a risk you are looking for? The legal risk, the technological risk, market or the reputational risk, which will be there, or maybe a kind of a operating cost will increase. There will be asset impairment. So, or maybe the shifting the consumer demand. So that is the something the transitional risk talk about. So you have to give both the risk. You have to disclose both the risk when you talk about the climate, that because of the climate, this is a physical risk and this is a transitional risk which I am working with. And that is something that one has to declare. So my dear friend, likewise, there is a governance matrix which is being given more or less same as we talk about the S1, strategy, risk management, and the metrics and target, which practically talks similarly on the S1, which I just touched upon. Similar to that is for the S2 as well. The only difference between the S1 and S2 is the S1 is a general disclosure, whereas we talk about the S2, it is specifically related to the climate related risk and the opportunity. So my dear friend, this was all from my side. I believe that I completed my presentation well in time, which is being given to me. There are many slides when we talk about the scenario analysis, metrics and target as far as the S2 is concerned, but I believe that I covered most of them in a very short time, so that we can give a brief overview on the what is this all about. Maybe Rashmi ji or anybody, the Pooja is there from the team. They can also comment upon, or maybe some in case some. If I will be able to touch upon Rashmi ji, maybe you can take some questions. I will also try to. When we talk about Deepak Vaishnav ji is talking about, is there any template for S1 and S2 available? So Deepak ji, as such, there is no template. I will say the readily available that you are looking for S1 and S2 declare. But yes, gradually they are getting developed, and maybe on a similar kind of industry, you will be able to get some kind of a basic structure wherein you can use them for giving the information. But certainly the information will be, I will say, on a for each of the organization, the information will be certainly separate. Yes, some kind of a template, or I will say some details can be made available with the passage of time. So the next one is any good group form available for sustainability reporting published by consulting organization. There are many reports which are available at the global level as far as this reporting you are talking about. In India, you are aware that we have to report in the BRSR format, which is already a standard format which is available. But at the global level, there are many organizations which are not only from this year, but also from the last few years. They are giving the very good detailed report as far as this sustainability part is concerned. I believe that the Rahul ji is also question the sample reporting. So are there any companies you can name? Right now on the webinar, it is not possible. We should not give any name of any company. But there are many companies which have adopted these on a voluntary basis. So at the global level, there are many companies like this. Then we have a question. Thank you, Deepak ji, for your comments. So Rahul ji, I just wish to share with you this IFRS S1 and S2 is compulsorily mandatorily applicable from the 1st of January 2024, and all these organizations which are following the IFRS practically, for them it is applicable now. As far as this, just to share with you, maybe Rashmi ji can support me, that this BRSR is mandatory for the 1,000 companies as per the market capitalization, the top 1,000 companies. But yeah, S1 and S2 is more IFRS based. So whosoever is following the IFRS or any other gap, it is there from the 1st of January.
And that is a voluntary.
Yes.
voluntary adaptation.
Yeah, I believe I wrongly mentioned mandatorily, so it is voluntary.
Voluntary.
Is there any template? So template we have answered for Deepak ji.
The thing is, sir, as you said, maybe in India it is voluntary, but if I am like, exporting to other countries, if they are asking that it is like you
It will
have to,
become mandatory.
it will be mandatory. Correct.
Yes. So, in which part of the financial statement? So, Santosh ji, just to share with you, it will be an integral part of everywhere. So, it is not a case that you have to give just the last one paragraph for the S1 and S2. You have to give, say, for example, you have to prepare some good metrics, maybe that, okay, you are disclosing in your financial statement that, okay, this is an impact of the sustainability related risk. So, it is more of an annual report, part of the annual report. That okay, you are giving when you are following the S1 and S2.
And sir, many are asking about like the role of CA in the sustainability report as such.
So Rashmi ji will be able to like you will be able to echo my this that there are many opportunities. So when we talk about the chartered accountant can do advisory in the carbon area. They can do for BRSR implementation, ratings, and the journey towards the net zero. They can handle the entire the trainings. They can provide the trainings and the implementation, the first time adoption of IFRS S1, S2. Then there will be the requirement of the assurance services as far as this disclosures are required. So I believe that I will be able to give the 20 such domains within this ESG area where the professionals can excel and develop the expertise, and there will be a lot of opportunities will be there. Sonia ji is asking, currently following the reporting standards. So there are many reports, Sonia ji, even for BRSR also, BRSR, that you can download from the various companies' website who are giving a voluntary report earlier and now mandatorily on the BRSR side. So you can download those as far as India is concerned. At the global level also, you can download those reports where for understanding the best practices as far as the ESG reporting is concerned. Sonia ji, PPT, we can share a limited version of the PPT. So you can speak to, maybe Jui ji may note down your email ID and she will speak to you. Maybe we can give a limited view, and we can speak to Rashmi ji also, that whatever PPT she can share with the all the IPR issues, she will be able to share us. So I believe there are, yes, Rashmi ji, if you want to take few questions.
Nothing as such, sir. Like if you were asking about double materiality, whatever I said. So when we speak, it may appear simple, but when we are working on fixation of the materiality, it's such a tedious job and it's a complex issue. It's not like single materiality where we identify few impact factors. So if we take the graph, on one side it will be the stakeholders which are in consultation, and the other side is the value for the company. But when it comes to double materiality, one side it will be impact on the community and the impact on the company. So to set that materiality and fix whether it is moderate, high or low risk, that itself is a challenge. And again, it depends from industry to industry.
There is a question from US side that whether the US is similar to ISSB standard. Just to clarify, my friend, that in the US, there is a Security Exchange Commission, which is actually monitoring and mandating that what kind of information one has to give. And practically, they are also following the ISSB related standard. For the Security Exchange Commission is also following the TCFD earlier, and now the ISSB. And so more or less similar kind of a situation is there in the US as well.
And someone asking whether any company has adopted it voluntarily. If it is IFRS, maybe this year they may adopt because it has been introduced this year. We may see few reports who will start adopting IFRS this year.
So I believe that we have answered more or less all the questions,
yes,
Rashmi ji.
Yeah.
So over to you, Jui ji.
Thank you so much, sir, and thank you so much, ma'am. And thank you for such a lovely deliberation, as well as answering all the queries being asked during the session. and it was a wonderful session. I would now request Mr. Rajesh Bhalla sir, again, the CEO of ESG Research Foundation, to share the word of thanks. Bhalla sir, kindly do the honors.
Okay, thanks, Joyji. On behalf of our ESG Research Foundation, I convey my hearty thanks to our honorable founder directors, CA Dr. Atul Kumar Gupta ji, CA Dr. Deepak Batra ji, and the faculty, CA Dr. Rashmi ji, for sparing their valuable time and gracing the occasion. Our thanks also to the participants for making this event a grand success. Our thanks also to our office colleagues, Juhi ji, Pooja ji, for making this wonderful program. And we are sure this webinar will prove to be very, very informative and thoughtful, thought-provoking for the stakeholders in their actions and decision-making processes. We will be organizing another webinar in March also. For the date, we will be notifying very soon. I would like to add also that registration for the 2 months online recognized course, that is Fundamentals of ESG and Sustainability, are already open by the Ramanujan College, Delhi University. The course is going to start from 26th April, and details are available at our website and also the Ramanujan College websites. So if they want to attend or join this course, of course, this course will be very helpful to the executives, professionals, teachers, and other stakeholders. So thank you very much. Thank very much to everybody. Thanks, Joyji. Over to you.
Thank you so much, sir. Sir has already given vote of thanks, but I would like to thank all the esteemed speakers as well as the guests, and especially the participants for giving us their time. As sir rightly said, we will be continuing with such webinars in the near future. Thank you so much for all your support. You have a lovely weekend ahead. Thank you so much, sir.
Thank you. Thank you.
Thank you, Rashmi ji.
Thank you.